according to this report right here, legendary investor George Soros has just bought a lot more Tesla stock. Now, I looked at this and I'm like, really? Something does not sound right. If you don't know George Soros, he's extremely rich. Right now, his net worth is in many billions of dollars, and he donated $30 billion to charity. That's a lot of money. He is more of a short-term investor, but still, he generated 20% annual returns in a span of about 40 years. So anything that George does, it's worth paying some serious attention. And supposedly he's buying Tesla. But when I saw that report, I'm like, something doesn't feel right. So I read this whole thing. It says here, based on a regulatory filing, Soros has taken advantage of Tesla's drop this year and loaded up on shares of the electric vehicle maker, tripling his stake in the past months. And so then I keep reading this. His Tesla stake was disclosed in the second quarter, which suggested that he started acquiring shares of the electric vehicle maker between April 1st and June 30th. At that time, the legendary investor held 29,883 shares as per a Form 13F filing. Soros now owns 89,647 Tesla shares through his firm. And this is where I was like, tripling. I don't know, like right now, the time to buy Tesla stock. Also, if you know George Soros and his stance in terms of politics and everything, like him buying Tesla stock is quite surprising. I mean, maybe it's not on a level of a kind of surprise where you would see, let's say, Joe Biden endorsing a Republican as to run for president and him supporting that. Maybe not that kind of extreme, but it was quite surprising to me because of everything that Elon is doing with Twitter. And this year, I mean, tripling. So then I was like, we also had a 3-for-1 split. Could it be that he didn't buy more Tesla stock, but it just looks like it's more because of a 3-for-1 split? So then I did some math. I mean, if it's exactly 3 times more, then obviously, probably he didn't actually buy more stock. So then I put in the number of shares that he had, and then let's multiply that by 3, and the numbers almost match, but not quite. It's off by 2 shares. So then I was like, maybe he is buying then because it doesn't match perfectly. I mean, Adam Jonas here from Morgan Stanley is saying very good things about Tesla stock and how it would have a bigger competitive advantage. So maybe he is buying, but then I started digging more because I really want to figure out, is he really buying? This is a big deal if he is. So then I go to Google and there's not really much. I mean, there's a few results, recent results, but not much. And then I find this article from the same website, but from August 14th. And here it says that George Soros has a little bit over $20 million worth of Tesla stock. This is before the split, mind you, 29,000 shares, almost 30,000 shares. Now, this new article says that his stake is 16.4 million. So we know that Tesla stock did not go down so much where if you triple your position, you would still only have $60 million in Tesla stock. I looked deeper and then I calculated if he did not buy any more stock, that his position should have probably lost about 30%. And guess what? When I look at the numbers and I compare at the time, right before the split, 20 million over, it says over 20 million, so not an exact number, over 20 million, which in August probably closer to 27-ish million, maybe, probably. So when I compare that with his current position here, I mean, clearly he did not buy any Tesla stock. So then you see something that seems a little bit off, don't come to conclusions, oh, this is happening. Check, double check, and then think. And then oftentimes you will find, we all make mistakes. Tesla already made a mistake here. Not really, they didn't state that he bought more Tesla stock, but it was clearly implied. It said triple his Tesla investment, which I guess that's not accurate because it didn't say tripled share count. It says triple investment, so you would assume that's tripling the actual amount of money that you invested, not the share count. Morgan Stanley released a new note, and this one actually you want to pay attention to. Oh, this one is a little bit funny and a little bit sad. We gotta take a look at this one. First, interestingly, Morgan Stanley does not think that next year Tesla will make a significant amount of money significantly more compared to 2022, which is interesting. Although they do expect strong growth after that. I guess if you are afraid of recession, that sort of maybe makes sense. The note says, can an EV slowdown drive capital efficiency? We think that next year shaping up to be a disappointing year for EVs. I don't think so. For Tesla, that is. Well, for everyone else. Yeah, probably. A combination of slowing demand and rising supply can have an adverse impact on returns across the EV value chain. This could be good news for Ford and GM. But then you read further and it's like, I don't know. They say right here that the auto industry has long demonstrated a value-destroying addiction to capital. And this is where it gets really interesting. You want to pay attention here. Auto companies feature highly cyclical revenue streams, excess capacity, high fixed costs, and high barriers to exit. It may seem odd that an industry that is known for only occasionally earning its cost of capital can so readily invest large amounts of precious and expensive capital into the latest trend. In the late 1990s, internet business to business was all the rage. More recently, it's been EVs. But you just wait. It gets even more interesting. 2023 set up to be a narrative-changing year as EV sales growth decelerates significantly from 68% year to date to as little as 15 to 20 growth next year. The potential impact of slowing demand and accelerating supply on margins should not be a mystery to economists and industry analysts. And watch this part. It's the capital not deployed that can frequently create the most value in auto stocks. That's almost like saying, hey, don't do anything at all. Like if you do nothing, that's like the best thing that you can do. In 2023, we think legacy automakers like GM and Ford have an opportunity to reconsider the quantum and timing of their EV investment plans, last established during a very different economic and interest rate environment of 2020-2021. Now, yeah, interest rates, of course, you have to take that into consideration. But here's the thing. It's almost like Morgan Stanley is telling GM and Ford to just abandon their EVs completely. Almost, but that's kind of like what it sounds like here. But then I go to the next page and it starts to make a little bit more sense. In our view, the winners among the legacy auto names pursuing EVs will be the ones that spend more frugally and efficiently on specific products. Sounds like Tesla. I mean, only really 2 different vehicles, Model 3 and Model Y right now, Model S and Model X, they're so low volume vehicles that you may just not count them at all at this point. Not the ones who spend the most across a wide range of products. That sounds like basically everyone else who announced we are releasing 30 terrible EVs that you will not want to buy. But because we have so many of them, maybe you will find the one that you dislike the least, that's maybe just barely good enough for you. And then they talk about Volkswagen spending billions of dollars, for example, to a $2 billion German EV plant, which got delayed from 2026 to the end of the decade because the software isn't ready yet. I mean, what does that even mean? The software isn't ready. How is that even possible? I mean, basically, what this whole note is saying is that legacy automakers don't know how to spend their money well. They just completely waste it. So when they actually stop spending money, this is where they actually are better investments, better stocks to hold. And you look at best-in-class return on invested capital, Tesla is strongly best-in-class at 29%, while its next closest competitor, BMW, is coming pretty nice at 18%, not bad, and Mercedes at 14%. And then you look at everyone else, and they're so low. I mean, basically what Morgan Stanley is telling legacy automakers, you are so bad at what you do. We know that the future is EVs, no doubt about it, for sure, 100%. Maybe next year the total market will grow a little bit slower, although I'm not really so sure about that. But that's what they say. But Morgan Stanley is saying you are so bad at what you do, just stop doing it. Just don't even try to transition. You're so bad at it. Just forget about it. You're going to just waste everyone's money. Because when you really think about it, I mean, if you want to survive and win and maintain your market share in the auto business, you have to transition to EVs. Otherwise, you will watch the number of cars that you sell just shrink. And no wonder. I mean, just let Tesla do all of the investing. I mean, 29% per year. I mean, that's almost as good as Tesla stock. That, of course, is just one of the 48 reasons why I only own Tesla stock in my stock portfolio. My name is Matt Pope. Just like and subscribe if you haven't yet. And I will see you right here. Thank you so much for watching.